Good morning, good afternoon, good evening, everyone, and welcome to another edition of the Suntech webinar series. I hope you and your family are healthy and safe during these difficult times. I am Sudhir Padia from Suntech, and I'll be the host for this event. For those of you who probably are not familiar with Suntech, a quick introduction. We are world's #1 relationship-based pricing and billing company with more than 135 clients across 45 countries. Across banking, financial services, insurance, telecommunication, travel industry. These organizations, these clients rely on us for rapidly designing new and launching hyper-personalized products, offers, pricing, loyalty programs, which touch more than 400 million end customers. Our products are cloud native, cloud agnostic, microservices enabled, and the solution can be deployed both on-prem as well as on SaaS or a software as a service model. The topic of today's webinar is around offering the best deals personalized to each one of your bank's customers. So to give a bit of a background here or context here, when we all shop around on the internet, or let's say on the Amazon or the most popular e-commerce sites, we all expect to shop for the best deal, don't we? It's natural that we also expect our banking, our banks to also offer the personalized products and services. Recently in India, for example, when we had our festivities here, Dasara and Diwali, there was a tough competition between banks to tie up with various online platforms aimed at offering customers no-cost EMIs, cashback, and instant discounts on purchases. So more and more banks today are rolling out new offers, pricing, loyalty, reward programs, cashback programs, deals, and discounts. And I think that's something which every bank wants to embark on. With the advent of open banking and the concepts around partner ecosystem or ecosystem banking, where banks are looking at limitless possibilities, bringing customized, personalized offer to the customer will require a full 360-degree view of the customer behavior and the customer interactions in a more real-time basis. So this is the topic of our day today. So how do you really build a real-time segment of one strategy supported by your enterprise pricing and billing program? So that's the topic of our discussion today, and our speakers will bring their perspectives from various markets across all the industry segments, SME, retail, and corporate side. Without any further ado, let me introduce you to the first speaker of the day, Rohit. Rohit Garg is the head of Business Banking and NeoBiz at Mashreq Bank. He has over 24 years of work experience, which spans across all aspects of commercial, SME, and retail banking across South Asia, Middle East, and Africa. So prior to joining Mashreq, Rohit held senior positions, including the retail head of SME and business banking for Africa and UAE at Barclays Bank, and the national head of SME liabilities at Stanchart in India. Over to you, Rohit.
Thank you, Sudhir. Privileged to be here, and I hope all the attendees and their families are in good health. It's a very interesting topic that we're discussing today, which is loyalty. Given that the banks have long been seen as relationship-driven institutions or proclaim that relationship management is primary, one would think that the best loyalty program globally would be offered by banks. When you look around, unfortunately, that's not the case. Let's delve into history a little bit and understand where this whole thing went wrong, or went away from being very relationship centric. As digitization came, the importance of branch became diminished. In the earlier times, the customers who were loyal built up a relationship with the local branch staff, and they were accorded privileges which were very personalized by the branch staff. either when they visited, or there were offers or exceptions that were given to them, which were more personal to them. Now, the advent of technology meant that this personalized privilege or reward started getting lost, and it was replaced by templated loyalty programs, which were supported by technology. They were usage based, um, and they seemed a perfect solution, right? They were egalitarian, they were not individual based, etc. But this loss of human touch also led the loyalty programs to be used like a hook to drive usage and acquire customers, and they became dependent on the product usage. And that was the major catch. Given the fact that they were more product based, most of these programs were then led by credit cards. Now, we all know banks are a very siloed kind of organization, and most of the silos in these banking have built some form of loyalty programs. They've developed pricing tools to give relationship based pricing, price discounts, offers, etc. And they've tried to give personalized offers to the customers. But the difficulty is that there is no interlinking to this web of benefits, and these are based on product. You could have a situation where a credit card customer could be having reward points, but he walks into the branch and he cannot redeem, or he cannot burn those points, etc., etc. And we will look at more examples. So the privilege and value was lost. There was no instant gratification, and it became per product and per use. Digitization in the last couple of years has opened up an immense opportunity to correct this anomaly. There is a huge amount of stress which is now being laid on ubiquity of channels, instant gratification, offers which are based on data, etc., etc. But I think that this entire conundrum is still not getting solved. I do have a couple of pointers to take us through that. If I could just move to my next slide. Before that, a little bit about the bank I represent. So Mashreq is a 52-year-old regional bank in the Middle East. It's got offices in 12 countries, and it's a full service bank offering corporate, retail, SME, and investment banking. We're also having what we think is a reasonably decent loyalty program, but I think we've got a lot more to do. So the question, post the background is why this loyalty program? Could a loyalty program propel your brand to be amongst the most admired brands? Are the benefits from a loyalty program such that they are not foreseen? And the biggest question, who do you think runs one of the best loyalty programs in the world? When we think of a great loyalty program, does any bank come to mind? So we are looking at loyalty across the board, not just in the banking sphere, but as a user, as a consumer, as a business. When you look at the best loyalty program or benefit that you've experienced, do you think a bank comes to your mind? So I want to give an illustration of Starbucks over here. Starbucks, we all know Starbucks, and you wouldn't sort of think that a coffee company would be running one of the best loyalty programs across the globe. While there's a lot of other elements on their marketing strategy, but the loyalty program has been one of the key pillars which has propelled Starbucks to become one of the 5th most admired companies in the world. I mean, it is in the company of the likes of Amazon, Google, Apple, etc., etc. Some of the benefits which are unforeseen, I don't know how many of us know that until 2019, the biggest or the highest usage digital wallet in the United States of America was Starbucks, and that was because of the loyalty program that they had, and many people had actually subscribed to the loyalty program, downloaded their wallet and their app, and they were the biggest wallet company over there. Unforeseen benefit. There was also benefit to their working capital, because many people prepaid for their coffee, and because of the loyalty program, again, you could pay for more and then use it as a gift card, etc., etc. So it's a great example of loyalty. Now the question is that, do we really think of a bank when we think of loyalty? Again, second question, in banks, who runs the loyalty program? Is it generally cards, or is it across the bank? Are loyalty, pricing, personalization synonyms in today's world? So, most banks have a loyalty engine, and that loyalty engine may or may not be linked to personalized offers. It may not be linked to a pricing engine. I move to the next slide. So what are the key ingredients? We've seen that how banks have moved away from what used to be their strength, which was personal, value-driven, privilege-driven loyalty, which was delivered in the last mile in a face-to-face interaction. Now, banks have certainly moved away from that. And today, digitization gives everybody a unique opportunity to marry the entire data set which is available and bring out a program which is enterprise-wide at a customer level. So I think the first key ingredient is that one has to move away from a product-driven loyalty program to a customer-driven loyalty program. The second is that in the digital world, where your face-to-face interaction is rather limited, it has to be the simplest possible program. No conditions. Your earn, burn, redeem, all of this has to be across channels and across products. I hope you can hear me, because the audio connection was lost and it says it's restored now.
Yes, we can.
Yeah. The next thing is hyper personalization. We all know that due to COVID, the prevalence of digital e-commerce has gone up dramatically. Now, one of the things that will come out of this is that customers now need hyper personalization. So the offers, the loyalty program has to be hyper personalized. It has to be customizable. So customers should be able to choose the benefits that they want. And the choice has to be with the client. The customer should choose how he wants to be rewarded for the loyalty that he's displayed. The next key ingredient to my mind is recommendation and intelligence based loyalty offers. And you could also add proximity based offers to this whole mix. So to give you an example, let's say there is, a customer has a benefit totaling, $1,000 or equivalent currency as a loyalty benefit. He goes to a store where these points or this whatever currency that is being used can be redeemed. If we use the data and have proximity based messaging, he gets a notification on his app that you can use these points or this currency at a certain store. You could even give him offers based on the fact that you have the data that he's shopped from this store in the past, and he typically eats at a certain restaurant, or he uses a certain service within that area. We could triage all of these three and use loyalty to make recommendations, give proximity based messaging, and even give offers which are based, because if you have redemption capability or redemption points across these stores, you have your previous data which can make a recommendation. More often than not, the merchants will also come up and add to the offer which the bank is trying to give. The next point will be linking with pricing engine. I think the fact that credit card loyalty gives you certain benefits either in the form of cashback or free usage, benefits which are lifestyle, which are shopping, etc., etc. But question is, does this translate into benefits into pricing? There are engines which banks are using which are enterprise wide. So it is not just credit card. You could be getting loyalty benefits across all products. But the key question is that, are you only giving loyalty as a standalone platform or as a standalone benefit? Or are you building that loyalty benefit back into your pricing engine as well? So how do you link the pricing engine? How do you link the pricing engine with your loyalty engine? And how do you link it back or into your data warehouse to read data which is related to usage, and then bring out merchant offers is, I think, the key ingredient which will come. The last point around this is, who runs the loyalty platform? Who runs loyalty for the enterprise? Is it the credit card team? Is it every business on its own? Or is it an enterprise utility? To me, a loyalty program is at a customer level, and it should be across every silo. I would even so far suggest that it should be across all business divisions as well. So to give you an example, if I am a small business owner and I have $1,000 worth of benefits as a loyalty currency with me, and I want to use it in my small business account where I'm the sole owner, can I do that or not is really the test of how good or bad the loyalty program is. If I'm a corporate bank client and I'm the CFO of a corporate, and my credit card is giving me some difficulty, should I be treated as a key client of the bank or for the bank, or should I be should I be treated like a mass market client with no benefit? Now, the definitions get a little bit blurred here because the customer of the bank is the corporate, but the customer of the bank, which is a corporate, the person behind that is the CFO who's been loyal to the bank thus far. So does he or does he not enjoy the loyalty benefit? I think is again the key question. To my mind, bringing out offers, bringing out data-driven offers, bringing out impulse purchase sweeteners, all of this is linking back to driving more usage, driving more product sale, but it should also have a leg into who's the person behind doing all of this. If it's a corporate, if it's an SME, is it the owner? Has he been a loyal customer of the bank thus far? And why should he not be given some reward for the loyalty that he's displayed thus far to the bank? He may be doing it across any product, he may be doing it across any silo, but from a customer standpoint, when he goes to the bank, either physically or digitally, he is typically not looking at that I'm a credit card customer. He is thinking that I'm a customer of this organization. I've been loyal to this organization for X number of years. I should be getting the best offer that the bank has to make to anybody. That offer should be fungible. It should have no conditions. The intention of the bank should be to redeem that offer, and he's earned that benefit from a customer standpoint. So that's why having a most simple, no condition, across the enterprise fungible program which uses all the data that the client gives to us for free, to make recommendations, give him the pricing benefit that he deserves as a loyal customer, and run it as an enterprise-wide program, I think are key ingredients for the loyalty program. So that's all I had to share, as a rundown on what I think on loyalty and benefits. Thank you.
Thanks, Rohit. Thank you very much for this insightful presentation. I think there are a couple of questions coming in. We will take it up after we've done with Clinton. Okay, thank you. Let me then move on to our next speaker for the evening. We have Clinton. Clinton is the Director of Banking and Innovation at Arise. He's a diversified core banking and IT specialist who is passionate about spearheading functional design within the banking sector, both locally and abroad, to enhance the customer banking experience. A seasoned expert with more than 25 years experience across multiple core banking platforms, he has played an instrumental role in using technology and innovation to transform banking systems across the globe. Prior to joining Arise, he fulfilled the role of a head of functional architecture at Standard Bank in South Africa. Over to you, Clinton.
Thank you, Sudhir, and thank you to everybody joining today. Just a little bit of context with regards to my role at Arise. We're fortunate enough to have access to 9 large multinational banks that are on the continent. And all in all, our investment that we have is just shy of $1 billion US. So we're the largest financial services investor on the continent. So being able to understand pricing and working with our organizations to find the best way of engaging with the customer is kind of what this discussion is going to be about. So to give you a little bit of insight, if you look at the great presentation that was given by the team from Mashreq, where Rowan actually gave insight into the customer engagement, looking at very much the inwards-outwards engagement to customers. So the customer value chain component of how you have an offer that goes to market to be able to offer to customer that product, service, or channel offering that you're trying to engage with. And when we look at pricing, we don't just look at it from that value chain engagement outwards, we also look at the value chain engagement inwards to the organization and what makes sense for the bank and how does the bank gain benefit from a financial engagement perspective. And I use a key example in all of my conversations, and that is in South Africa, I bank with one of the big 4, or actually 2 of the big 4 banks in South Africa, and one of the banks pays me to bank with them. And what I mean by that is, if I look at my service fee charges that I get charged per month, and I'm going to use a dollar comparison, I get charged close to $50 US a month for my service fees, and that is all conditions entailed. That means my cards, my service for payments, for any of my loyalty programs that I have, everything together is $50 US. By the end of the month, I have this bank pay me $150. So all in all, I make $100 profit off the bank for doing banking with them. And the reason for that is because I understood what is the parameters that drove the engagement to market. I understood that the bank was offering as a loyalty capability, if I had ticked the right boxes, I would get a bigger benefit than having to pay for service fees in an organization, which is scary in its own right. So when looking at pricing and looking at the capability, it's critical for organizations to understand how do they adapt internally that the value proposition that they go to market with is actually cost effective, number one, that it has a capital input ability for the organization, 2, de-risks the organization, 3, and then we don't have a case like Clinton Abbott that we pay him to bank for us. So it's those types of things that we look at within the organization. So the important thing is I'm going to start with what we term outwards in. Now, outwards in is the definition of customer engaging to bank at front door. So it means that a customer walking into the bank virtually, physically, or through any engagement, how would you deal with that engagement with the organization? So we look at things like, number one, if we are looking at pricing and we're looking at pricing as a capability, we should consider that we want to rationalize our products. So we look at things like not just identifying a go-to-market strategy of we want to offer a new notice deposit for customers in the market, we look at the whole pricing component linked to that. And we say, if I have a go-to-market strategy of looking at a customer, how many products are behind that strategy to be able to engage with the customer value chain? So if I take a notice product or a fixed term deposit product, for example, most of the banks have got 3 primary products. They've got a 30, 60, 90, 180, and sometimes a 360-day fixed term deposit. When you re-look at that opportunity and you start saying, for us as an organization, for us to manage those 3 or 5 products has an extremely large overhead. Because linked to that, I have got segmentation rules, I have got additional pricing from an interest perspective. So those products, invariably, I end up having to manage 40 products because I've got each one of those products sitting within a segment. Each one has got its own specific price list. Each one's got its own variable pricing component. So it becomes lethargic for the banks to manage. When you look at looking at the pricing capability and using product to your benefit, and you start saying, if I go to market and I offer a customer a product, I can actually say that fixed term deposit is a single product with pricing variables that sit above it. So if you look at a fixed term deposit works on 2 primary sets, one being the amount and the second being the tenor. And based on those, there's an interest rate that is allocated to that. By looking at the product rationalization and looking at how do you use pricing to benefit that, what ends up happening is that you have one fixed term deposit using variables with regards to the time, the tenor, the interest rate, and you can actually offer to the customer, pick the date you want. So for example, where you now had your 3 or 5 products, your 30, 60, 90, 180, and 360-day products, what now happens is you've got one product, but any variable that you want. So if a customer says he wants a 137-day fixed term deposit, you can give it to him because the variability does not sit within the core system. The variability sits within the pricing that actually defines the product. So when we look at how do we go to market to offer that engagement to customer on the customer value chain, we also look internally in the organization of how do we rationalize and manage ourselves more effectively, specifically around our product aspects. And when you really sit down and you work with the organizations, you start realizing that the 290 products that you might have, variables with regards to a product for every single type of segment or for every single type of opportunity that you go to market with, you as an organization can reduce that to 8 primary products. And in some cases where banks are really smart with it, you can actually take it down to 6. By managing those 6 primary products and using pricing capability above to be able to manage your price list, to be able to manage your segmentation, to be able to manage your product variabilities, means that the complexity of organization is thus reduced. The next thing you look at is, because you're using pricing as an engine or using pricing in a variable state, means that your reporting capability as what is your segmentation analysis becomes a lot more richer in capability. Because what happens now is, if you look at how customers engage or how customers from a lifestyle perspective have been affected by COVID-19, this has been a reality check for banks. And what I mean by that is, if you look at a normal trajectory of a customer joins the bank, be it as a student, he has student loans, student products, he then slowly finds his first job, he then moves into a blue segment with regards to his check account, and from there he progresses to silver, to gold, and hopefully one day he'll be a private banker. And as bankers, we look at that and we say, that's the trajectory, that's the way the customer goes. Now, to be able to move between segments means that you either have to close the product and have to generate a new plastic, i.e. a new checkbook, or be able to generate a new card and have a gold card or a platinum card according to the segment change that's happened. What happens is you have to close that product, change the account number, next product, change the account number, next product, and the disruption to customer is incredible. When you really look at it from a bank perspective, you start saying, go back to that example that I spoke about, fixed term deposit, where the account is the single capability, so check account, irrespective of segment, and the pricing identifies the segment move of the customer. Now, if you use this whole growth trajectory of this is where you believe the customer needs to move towards, and a situation like COVID happens, you can immediately identify that the segmentation of that customer has now dropped. So for a customer that originally was maybe following a trajectory of an executive of an organization, had large mortgage loans, identified certain criteria of vehicle finance and all of that, and then has full low, so literally loses his job. How is us as banks being able to adapt and be able to deal with that customer and deal with the product to be able to assist the customer in that situation? So the segmentation is now thrown upside down because the customer sits in a product-centric environment. By looking at pricing, you move into a customer-centric environment, moving away from product centricity and using pricing to derive how you move up and down that segment. So for banks being more effective of going up the segment from a growth trajectory, but when something like COVID happens, being able to reduce your customer segmentation and adapt your products or your pricing or your capability according to what the needs of the environment are. And especially with COVID, when you had governments that were saying that certain transactions should be zeroized, how many banks were faced with the situation of hard-coded pricing sitting at product level and having to get teams to actually go into the organization to be able to adapt their pricing accordingly? By having variable pricing in a situation like that, you could actually say zeroized pricing according to the transaction, according to the channel, according to the capability, and it gets consumed across all products invariably. At the same time, we identify how do we use the product and pricing to also do what we term behavioral manipulation, which sounds absolutely terrible, but financial experts that are sitting on the call, bankers that have been dealing with this environment for quite a few years, will understand exactly what I'm saying. Behavioral manipulation is how do I move customers off a branch-heavy brick and mortar intensive environment into a virtual online capability by being able to offer them the same service or better service through a virtual state than through a brick and mortar hard face-to-face capability. And that is actually behavioral manipulation. Being able to manipulate the customer to understand that it's better for him to not be in branch and to rather be on an online state. So by using pricing engines, by using all of these data analytics, by looking at the product rationalization I spoke about, you're able to also drive a certain behavior for the customer without putting an entire environment at risk. So for example, when you look at a cash withdrawal, being able to identify the origination point of that cash withdrawal in branch versus on ATM or versus at a point of sale device or through a third party, example, agency banking, many times the banks are sitting with that whole conundrum of I only identify a cash withdrawal in a single state. I don't identify a cash withdrawal based on a variable state being a channel identifier or something like that. And the way that they fix that is usually through analytics behind the scenes, reporting and all that capability. So by looking at your pricing and identifying how you move your customers into that virtual space, you really look at the value chain internal of the organization and the whole workflow of that transaction. So when re-looking at the transaction, you identify your variables. You identify things like my product that is requesting the service. Identify the depth of that service, i.e. point of origination, point of destination, currency, time, location-based. Any analytics that you can add onto that transaction allows you now to personalize that transaction from a delivery perspective and thus reduce your costs as an organization. So it's one thing, yes, I am doing a customer-centric ability for outbound to customer to be able to give him the service requirements, but we're bankers first. We also have a responsibility to be profitable. We have a responsibility to be able to have our own organization grow and have the ability to engage with our customer more effectively. So it's not just one-sided. It goes back to what I said earlier. Does the bank pay you to bank with them? We're not in this business for free. We're in this business to make money. So being able to utilize these types of things is where you get the benefit as organizations. At the same time, we start looking at things like, how do we join the dots to the offer? What we mean by join the dots to the offer is that if I have a capability or a pricing list that is going to market that I now have offered the customer and signed the customer on for, being able to understand that he was supposed to agree to, so things like the deposit levels that he needed to hold, the servicing that he was supposed to deliver to us, the ability to bring income into the organization. If he met all of those capabilities, the price list would be active or inactive. Because many times what we find in our organizations is that customers will say that they will do X amount of transactions or X amount of capability for us. We sign rebate offers for them, and what ends up, the customer never meets their side of the bargain. So it's always one-sided. We're trying to be customer-centric, but we forget that the bank is also trying to make money at the same time. So by joining these dots and making sure that all of these things are tied together, we ensure that we have return on investment, or that we have as a capability to our customer makes money for us as an organization at the same time. Simultaneously, because of all of these analytics, because of looking at pricing more holistically, by looking at how does it engage from us as an organization, for the first time, organizations start seeing the reality of customer profitability. Now, it is a myth that everybody thinks that customer profitability can be done with the tick of a hat. Unfortunately, it's not. This is a roadmap that needs to be undertaken by organizations. You need to have proper cost-based analytics that need to be running across everything from your channel understanding, from your branch capability, from infrastructure, from product. Even your HR charge rates need to be sitting within the system. But this is the first step point to be able to understand, because I know the transaction, because I know the segment, and I'm controlling that, because I understand the transaction capability, throughput, and go-to-market strategies. By pulling that all together, I've got the first time an holistic view of that customer and his engagement into the world of the bank. We also have the first time ability to be able to invoice the customer. And many times this is misunderstood, that it's only a corporate capability where we need to be able to invoice the customer on services rendered. Customers are becoming a lot more au fait with how much it costs to do banking with an organization. And also many times they'll come in and say, please explain to me what was this charge for? Or please explain to me, why are you charging me these additional services? By having these capabilities in a pricing engine, you're able to identify very quickly what that pricing invoice for that customer is, and being able to isolate it, because, like I said, you've got the customer profitability matrix, you're able to generate an invoice, and you can deliver that back to the customer. Thus, you are also enjoying a better service capability to the customer, not just from a value creation perspective, but in a service delivery perspective. And then also at the same time, we've got the primary ability to understand our cost of capital. And this is also something that many banks don't really look at. They say pricing is only transaction-based pricing. Pricing is only something that I identify a transaction, a loyalty, or an engagement where the customer is generating outside of the organization. Actually, that's incorrect. The other whole 50% side of the coin is, what does it cost for me to manage that product? What does it cost for me to manage the capital that is generated against that product? And being able to understand what my profitability as a department, as a subsidiary within the organization, as a product capability, and how do I engage in the organization to understand how expensive is it to run that product? How expensive is it for us as an organization to have an extremely high deposit rate, have an extremely high deposit capability, so the amount of accounts, and if you look at the cost of capital to be able to manage and pay those accounts, it is not cost effective for the organization. So being able to adapt your interest pricing according to the transactions, according to the needs of the organization, while at the same time the needs of the market and the needs of the customer, you start understanding that whole bank value chain aspect. So not just the customer value chain where you look at outwards, inwards on how do I take a price list to market, but also outwards into the organization of what is the bank value chain component and what is the benefit to the organization and how do we make money. So thank you very much. I kind of a little bit overran on my time. It's a great discussion, and hoping we can answer some of the questions that might be raised. So dear, back to you and the team.
No, thank you. Thanks, Clinton. Thank you very much for helping us connect the dots as you did very well, from product to customer behavior to segmentation and then to pricing and billing. So great. Thank you very much for that. We have about 15 minutes left, and I think there are questions being asked. So can I request both of you to just turn on your cameras and the mics, please? Clinton and Rohit. Okay, brilliant. Thank you. The first one is for Rohit, for you. This is typically we have seen loyalty programs linked to retail customers, right? And since you now talked about corporate banking. How do we see loyalty programs being conceptualized in the corporate and SME side of the business? Will it continue to run as is, or as individual contracts and individual negotiated deals, or there can be hyper personalization possible as well there?
Yeah, it's a great question because I think as customers are moving from look at it, so I will answer it in this way that I run the SME business banking piece in the bank, and I once met a client at a dinner who told me that I was telling him that, look, we value your relationship. You've been banking with us for a long time. I've known him personally for 7-8 years, as an SME client. And he said, look, we meet every year once or twice, but do you really think that you value my relationship? I said, of course. Why do you even ask? He said, look, your credit card gives me a chance to play golf, gives me lounge access, etc., etc. But you've never really offered anything of this sort to me. And why do you think there is such a differentiation? And I was surprised by the way he articulated. He said, look, credit card is just a small usage product, right? I maybe spend 10, 15,000 dollars on it every month. But here I've got $4-5 million of relationship with you. Why this differentiation? So that got me thinking, and then we did a little bit of survey. So there are clients who want to know that if they've got $2,000 worth of benefit on their credit card, why can't they use it on their fund transfers? I'm talking about small business as of now. So that is one part. Now the way to do it is simple. That we were also not offering loyalty on SME till very recently. In fact, surprisingly, most banks don't offer loyalty on SME because there's this inherent thinking that if we are offering credit to a client, why should we give him loyalty? Yeah, by and large, that's the thought. And when you start doing it, or when we started investigating, I realized that our data or our corporate and SME data was not even flowing into the loyalty engine. The loyalty engine was primarily being run by the retail part. And first step was to get this data flowing, etc., etc. You can create various events. You can have price offs which can happen post fact. You can have it at the point of transaction, etc., etc. Now, contract based loyalty is relevant more or less where you are already doing personalized pricing or bespoke pricing for a large corporate. But the same loyalty, can you offer it to the owners and controllers of that account? I think that's the question. You're giving him a price discount as a corporate, but that same CFO, when he goes and asks for a credit card, right? Does he get any benefit of being loyal to the bank or not? That's where this whole riddle starts getting a bit more interesting. So it's still easier for small business SMEs because the people are one or two, and they can easily be this program can very easily be fungible. So the same client, if I had a loyalty program running at that time, I could have mentioned that whatever benefit that is accrued to him on his credit card, he could redeem it on his small business account as well, because ultimately he's the same person. It's a one single ownership company. So I think that's the way clients are at least coming back to us, and that's the way we are trying to build our loyalty.
Sure. Thanks, Rohit. Thanks for that. So typically, and a follow-on question on that, banks have very complex IT landscape. Now, when you talk about personalizing the offers for either individual or SME, how easy has it been at Mashreq to sort of come up with the offers in the market? And then the other question also was, you talked about for the corporate and SME business, how do you track the commitments that these corporates have given to you? Because you talked about some of those earlier as well. So some thoughts around that?
Look, first thing is that how do you do offers, right? And how do you manage that whole offer landscape? I think there's a lot of tools which are available now. We've been working on data for a while, and usage-based next best offer, part of the customer 360 view at the point of transaction, is the easiest or the most obvious answer. So based on, and I'm talking about retail customers and small business customers. So looking at the whole CRM as a tool which is used by all frontline, making sure that the analytic engine at the back is creating the next best offers depending on the algorithm that you built around it, and that offer is available to every customer touch point, whether physical or digital. So if the customer is logging in digitally, do we have a conversational tool, or do we have an engagement tool by which you can give him that offer, right, which is being run by the analytics engine at the back end. Now, it is not 100% automated, so we are still not able to do literally one-to-one communication. But when I look at what we were doing, let's say 3 years ago, where you would have one offer and you would just spray it across your entire base by using either an SMS or an EDM, I think from there we made huge steps forward where you can cohort your customers in a major way, and then do cohort-based next best offers depending on usage. And there was another part to the question, which is that how do we do it? I think there are plenty of tools available now, are pricing loyalty engines which are married together. I think one good thing that we as a organization did was that we made loyalty and pricing as a enterprise-wide utility rather than a credit card utility, and that really helped in a major way. Last bit is how do you track commitments and price discounts which are offered. I think there's some work to be done over there, but some steps that we've taken is that every offer that we give to the clients, which is volume, has an expiry date. Yeah, it's a very simple thing, but when we started, we discovered that there were offers which were, or price discounts which were given and which were fed into the system 10 years ago, and those customers had never kept their the volume commitment which warranted this price. So one is, now every offer has a expiry date, and there are again tools available through which you can do periodic assessment of the volume commitment vis-a-vis what the actual is. So again, we're looking at those tools and generating reports to see. I mean, we don't have a tool as of now, but we're in the process of evaluating if we can get one.
Sure. Thanks, Rohit. I've got a couple of questions for Clinton. So Clinton, you successfully done multiple core banking programs, and you also talked about the need for an enterprise-wide pricing engine. So how do you see a pricing platform, helping banks hollow out their legacy core system and bringing into an enterprise layer? The need for an enterprise-wide pricing platform.
So it's quite an interesting question, because if you start looking at where core banking programs are moving towards, instead of doing the large monolithic core implementations, most banks are not following that approach. They are de-risking their environments. They're moving more to componentized capability. And that's good from our perspective, in the sense that putting the pricing engine in and leaving the core to do what the core is really good at, which is predominantly large transaction processing. It is not there to get creative. And what I mean by it is, when you try and do many of these things that I've spoken about in a core system, you're going to have the core banking team saying that they need to customize the hell out of the system. And there isn't a level of customization that can meet the objectives of having a standalone pricing engine from a capability point of view. And What I mean by that as well is when you start saying that the core just needs to process the transaction, it needs to do the GL postings, it needs to make sure that all of the reporting is done effectively, it does not need to decide whether that interest rate that I am using is the right interest rate for that product. It is not the one that needs to decide whether the transaction pricing should be X, Y, or Z. All it needs is tell me what the figure is and I'll post the figure. So what we do is we look at it from a perspective of the channel engages with the core system. It says that I need to do an online verification or online authorization for an amount, considers the pricing charge in that, and then tells the core system, post this transaction, and this is the pricing aspect, or the pricing will come through on a batch job. It's not that the core decides that the authorization should include the pricing component. It's everything but. It just processes. The capability sits at the pricing engine as well as from a channel perspective. So what I mean by channel is also front end on your core banking, I mean your front end in branch, also your ATMs, your point of sale devices, internet banking, any of those capabilities that will then decide that transaction that I'm doing, how should I price it? That product I'm opening, how should I transaction price it? How should I interest price it? That capability that I'm doing as a go-to-market for the customer, what is that offer to him holistically? So it's not just I'm offering you a product with this benefit. I'm offering you this product, and if you take that, I can look at my additional products that I have with you, and I can reference and I can give you discount rates accordingly. Now, the benefit behind that is that customers look at loyalty from two perspectives. One is a tangible loyalty, which is something that they say, I can get a TV at the end of the year, or I can get discounts on airfares and that type of thing. And then they've got an intangible loyalty component. That intangible loyalty component is at transaction or at holistic bank engagement level. So a customer would say, I want to be able to purchase my dinner tonight at that restaurant, and as I'm doing the payment, I want you to take 50% from my wallet based on the loyalty points that I've got, and the other 50% I want to come from the bank. Now, managing all of that might seem complex when in actual fact it's not. Because when you look at the workflow of that transaction, you start saying, well, I just need the loyalty system to tell me how many points. When the transaction comes through, route it first to loyalty, take the balance of payment from that, offset it against the total charge of the dinner, and the balance I need to send to the core banking system to provide the transaction flow. I haven't changed the core. I've changed the channel engagement. I haven't changed the customer. I've changed the channel integrator. So when you start looking at it from that perspective, I use components and modules and a basic chaining together from a workflow perspective to be able to offer these crazy capabilities. And when you start looking at that, you start really getting creative and you start saying, well, how could we do other stuff? So how could I build an ecosystem of a certain type of SME group? How can I build an ecosystem according to a location or according to a channel setup that's been done? And that's where agency banking comes into play. So if I have agency banking in this location with these sets of customers, and the SMEs are servicing those customers that bank with us as well, zero-rise their transaction. Now, that is a price list that you build in. That is a capability that you can offer, and it's not going to require a new product. It's not going to require changes to your core. It's not going to require changes to any of the other systems. You're changing your price list. You're changing that offering. So our recommendation that we say to all of our banks with regards to this is that you need to rethink how you engage into the core. You need to understand that when it comes through the door, I'm not going to customize my environment. I'm not going to customize my core to the nth degree. I need to use an enterprise service that can do everything from a pricing and capability perspective. And that's what we tell them. Look into the capabilities of pricing. Look into what you could use from a global perspective, as well as on-prem versus software as a service. I mean, many of them do offer this capability. And I think it really is going to turn the organizations around, and it's going to relook at how banks have go-to-market strategies.
Sure. Thanks, Ritin. I think there's a follow-on question and an interesting one on the business case itself and the ROI. So when you've, based on your past experience where you have deployed an offer management system or a pricing engine, What kind of business benefits have you seen in that organization in terms of reduction in time to market and attracting more customers and so on and so forth? Was the ROI itself fast enough for you to justify the rollout of a platform across the bank?
So two things actually. So in one of the markets that we deployed it, we found 150% growth in product sales within the first month of go live. Now, this is a country where the product growth was, I would say, lethargic at best. And we really looked at how do we have a go-to-market strategy of engaging SMEs specifically. We said the SMEs that actually come into the bank are an extremely cash-intensive society. So two things happened. We looked at the people that were standing in the queue outside the branch on a Monday morning, and there were close to 150 people that were standing in the queue. Out of those 150 people, people looked at the bank and said that the bank has got problems because those people are standing to complain at the bank. When in actual fact, it wasn't. It was just because the bank had a really good deposit rate. They also had the lowest service fee for managing accounts. And that's why customers were banking with us. It wasn't a proper go-to-market strategy. It was just because we were cheap. And like I started with my presentation, we really looked at how do we not bank people for free? And how do we make sure that that benefit that we do have benefits both parties, both the customer as well as the bank? So we investigated that queue. We looked at who was standing in the queue. We understood that the first 10 people were the critical. And what I mean by that is those 10 people were always standing in the queue in the exact same point every single day. And it was actually an ecosystem. So those 10 people, it was the liquor store owner, it was the guy that had the restaurant up the road, it was the hotelier, it was the hardware store, it was the butcher, and I can't remember what the other two were. But they, between themselves, had built their own ecosystem of trade. So they would come in, the hotel guy and restaurant guy would say, this is what my order is for meat, and would swap cash with the butcher. The butcher would then say, I need to also make sure I'm having a party the weekend, so the liquor store owner, I need to buy liquor from you, and he would swap cash. And based on that, the cash movement between those 10 people was realized before it even walked into the bank. So we were actually inadvertently building the ecosystem because we were cheap bankers. So when we also looked at it, we said, right, we need to make sure that A, I can engage these customers more effectively. B, how do I actually have a proper product that benefits them as an ecosystem? How do I also reduce this whole long queue of 150 people standing outside my bank on a Monday morning? And how do I become more operationally efficient? So we took those, we broke it down, and we said we want to have an offer capability of a product for those 10, number one. So we built an SME product for them to be able to all engage with. And if they were doing transactions between themselves in that ecosystem, they were zeroized price. At the same time, because they were doing deposits among themselves and there was cash movement, we would clear that cash immediately. So if you did a deposit into that account, we would give you instant access to those funds and not have a whole period of first validating and checking like they would have in the past. At the same time, we started saying, well, how do I get them to bank at a different time? Because between 9 in the morning and 11, I had everybody coming into the bank, and then I had death. I had nobody coming into the bank until 2 in the afternoon, and the bank was empty. And then in 2 in the afternoon, I had everybody coming into the bank again. So how do I operationally efficiently manage that environment? We spoke to those 10 guys. We said, if you bank later, could you have a benefit out of this? And they were open to it. So what we did is we then used the pricing engine to manage the transaction times that would come in for those deposits or withdrawals or anything that the bankers were doing. We also identified any service agreements that were being done during that time. And we said that anything that happens during that time, the customer would get the benefit from a rebate option at the end of the month. We then told the rest of the customers to come in and bank at different times. So we increased our efficiency of branch. We increased our customer engagement model. We increased our transaction throughput, and we increased by 150% the amount of products that were sold just based on one branch and one capability. What then happened was, there was a crazy link to it, was that when you have bad weather in downtown Kampala, Now customers can't come in and bank at that period of time. So what we did is we also built an integrator into the Norwegian weather service. We identified the GIS location and ring-fenced that GIS location of that branch. According to that branch, according to the weather, according to that date, according to that time, according to that transaction, according to the customer and the value of transaction, we would price that moment in time. So because of all of that, we could actually price by the weather. And we could actually engage the customer that if he came in late, because there was weather in downtown Kampala, we would move the pricing by 1 hour and give him the benefit because of that. All of that increased our customer acquisition. We were seen then as being more customer-centric in our engagement. We understood the SME, and that then just proliferated right across the country. And the bank then became literally the leader in SME in a matter of 6 months.
Okay, great. Thanks, Clinton. I think we're running out of time and you exceeded by about 5 minutes. So thanks, Rohit and Clinton, for your valuable insights, and thanks for your time. Thanks, everyone, for attending the webinar today. And we will be sharing the link of this webinar so you can replay it at your convenience. Thanks once again, and have a great week, and stay safe, stay healthy. Thank you.